We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrigrix. Joining me today is Bob Coleman from Idaho Armored Vaults. How are you today, Bob?
Good, Tom. How you doing?
Excellent. So we have you here today to kind of give us a run through of a presentation you gave last week at the Silver Symposium. And we're going to go through kind of a highlight of the real study that you did leading into that presentation there. So why don't you share your screen with us and we can get it started.
Sure. Okay. So basically the Silver Symposium, just for people that don't know, they tried to bring back the old Silver Summit that was out of Spokane years ago. And so this was the first sort of year they brought this back. And with COVID and everything, they had a decent turnout. So and it was a good chance for people to start to communicate one-on-one together instead of via social media or Zoom and that type of thing. So it kind of brought back that old school feeling of actually communicating without the noise that you get from Twitter and other things. So, but the presentation I did, I focused on something that I haven't really seen much on, which people do talk about how the futures market sort of overshadows the price of the physical market, but I wanted to kind of dig into that a little bit more and try to understand, do these ETFs and funds have any bearing on the price at all, or are they just acting as sponges to absorb money that probably would have went into actual physical metal held directly, for example. Just to kind of get into the presentation, which of course you can see the whole presentation on our website, goldsilvervault.com. Just go to the menu section under media and then choose webinars, and you could actually pull up the slide deck that was used as well to kind of follow along with that presentation. But this kind of gets into the middle, sort of right near the beginning of the presentation, which I wanted to show why silver, which was the focus of the event, why I think silver is still undervalued and has not seen its day in the sun yet. So I kind of looked at this from 1971, just trying to get a gauge for the S&P 500, how that's up about 4,500%. Gold's up about 4,100%. For silver, which is only up 1,600%, for that to actually equalize in terms of performance, silver would have to go to about $65 an ounce. And as you can kind of see here, silver, which is in gray, gold, which is in gold, and the S&P 500 in red, you can actually see there's periods where actually silver performs on a relative basis. It outperforms the stock market. And so as we get to this divergence that you see here, where the stock market has just gone into launch mode, and yet silver has been sort of floundering here in the 20s. You have basically an enormous gap here that I think you'll eventually start to fill at some point. And like most cycles, hard assets will eventually become more popular versus paper assets, and you'll see a reversion on the mean, I guess you could say. And then this is just another quick measurement of using silver relative to the S&P 500. Again, just wanted to show, we're right here in this really small area in terms of the ratio. This is 2011 versus 1980. You can see from a relative valuation to the S&P 500, we have nowhere hit any type of euphoric measurement. In fact, actually, which I found kind of interesting, was silver right now relative to the S&P 500 is cheaper now than it was back in the early 70s. So to me, it's one of the last few commodities out there that has any type of semblance of 1970s pricing.
Mhm. So does that necessarily mean that that silver is going to come up to meet the S&P, or is it that the S&P can come down to meet back up with silver, kind of thing?
Yeah, you're absolutely right. It could be either or it could be a combination of the two. So, and that's one of the reasons why when you look at the prior chart and you look at just performance, yes, there are times where the S&P 500 does come down. Back in 2008, for example, yeah, and silver obviously got hit as well at some point. But you see the relative performance. The S&P lost a lot more than silver did. At some point during that 2008 sell-off. So you what you're trying to do when you gauge, from a money management standpoint, you're just trying to look forward and say, okay, how much more downside is there relative to another asset, or how much more upside is there? And at this point, silver, for me, looks a lot like a lot better value, or a lot more potential to the upside over the next 5 years, for example, than the S&P 500.
Mm-hmm.
And yeah, it's all probabilities. So then I got into I wanted to show the relative price performance, which is here in gold, for example, relative to the number of ounces that come into the ETFs and mutual funds. And here in this gold chart, you can kind of see the ounces are in blue and the price is in yellow for gold. And you can kind of see there's actually a pretty decent correlation between price movement and the number of ounces. But where it gets interesting is the white metals. Palladium has almost no semblance whatsoever to ETF flows and the price of holdings. You can see here a massive dump in ounces came out of the funds and ETFs. At the same time, the price just skyrockets. I mean, it makes no sense whatsoever.
Do you think a possible explanation, Bob, would be that it has more of an industrial demand to it rather than a monetary or, let's say, inflationary hedge demand?
Yeah, no question about it. That's palladium and platinum obviously being used in industry a lot more than investment. That's certainly a viable reason for that. But at the end of the day, a lot of times these metals, the investment demand tends to drive the price, if that makes sense.
Mm-hmm.
Because industry is going to be fairly consistent in use. You're really looking at supply deficits or supply surpluses at that point. And that's where the investment side tends to absorb some of that extra supply. But here you have palladium, platinum, a little bit better in correlation, but you see that there are times where platinum leads the market in terms of the price, leading the number of ounces coming in. And there's sometimes where the number of ounces coming in has absolutely no effect whatsoever, and the price just collapses. You can see like a little hiccup here, just a little bit of platinum left the ETFs, but you had a massive crash in the price. So again, you're just trying to get some consistency with how institutional or retail investors act, and then how is that relative to the price.
Mm-hmm. So really, what's driving the price, right?
Yeah. You're just trying to figure out, do these ETFs actually have the effect that we all think they have when you see a lot of money flow coming in? Then you get to silver. Silver is interesting because silver, sometimes the price leads. You really have to look at it after 2000, because that's when ETFs and silver actually were developed. But here you have the price tends to spike, and you don't have the fund flow characterization where you had a spike in number of ounces coming in like you did on this upward channel leading up to 2011. And then you'll have times where even more metal is added to these ETFs, the price collapses. And then of course you have record high ETF fund holdings, and the price has gotten nowhere near back to where it was in 2011. I mean, so there's a lot of factors there that it's hard to make a strong correlation with that. And then what I did was I tried to show a period of time, like 2008 was a great period where you had this is the silver ETF from January to September. In blue here is the number of ounces coming into the fund, and you showed a strong projected upward movement in fund flows coming into that fund buying ounces. Oddly enough, the price in red, the price tanked in March, and yet there were still ounces relatively coming into the fund. It kind of went sideways. You never really saw a big drain in the silver ETF. Mm-hmm. And then you got to August timeframe where the price peaked out. I think you actually had a Sunday bloodbath, that started this whole mess. You actually had between this period when silver ETF really started to sell off, when the price started to sell off hard, you had an enormous amount of ounces come into the fund. I think it was 5 or 10% of the world's production come into, or maybe as much as 15% of the world's production come into the ETF in a very, very short period of time, yet the price dropped 25% in value. So, I mean, that's a head scratcher right there. So otherwise you typically see absorption, at least the price would stabilize, you would think. Mm-hmm. Well, then what I did is I said, okay, you had 43 million ounces or so added into the silver ETF during this January to September timeframe, which is 1,500 tons. Then you look at the futures market, and this is the open interest of the futures contract for the silver Comex contract. And you can see really from January or actually from March when it peaked out, actually toward the end of the year, you had over 100,000 contracts liquidated, which is 500 million ounces, which is about 17,000 tons, which is basically 10 times the activity that came into the silver ETF. Mm-hmm. And if you look at the price action, you could see that the price action mirrored the futures price much more so than it did mirroring the actual physical market. As people were accumulating more silver, you didn't see that it didn't really have the impact on the overall market. And of course, anyone who was in the market in 2008 saw real tightness in a lot of the retail products. You saw up to 4 months of delays in delivery to get Silver Eagles or anything silver. It was just crazy. And so here I kind of talked a little bit about pricing discovery versus pricing behavior. Really, from a pricing discovery standpoint, that's typically what a price that's kind of set on the spot market between for an asset or commodity versus pricing behavior that's more focused on the intangibles like psychological, emotional behavior aspects. And you see it with trading, hedging, speculation. The Comex is a very it's a market that's driven more by speculation and paper trading than it is actually for the physical metal that's underlying the contract. Mm-hmm. Most people don't take delivery of the contracts. I think it's roughly about 2% actually ever take delivery of the overall contracts being traded. So removing the leverage to me reduces the influence or impact the paper market can start to have over the physical market. And that's why we've been seeing what I'm about to show here is a deleveraging that's been happening in the silver market. And this is an interesting chart. This is basically the combined open interest of the silver contract, the Comex contract, going back to 2006. And you can kind of see we've been in this upward channel, kind of defined by the two black lines, where you had open interest growing, volume activity was growing. It was a healthy environment for the futures market, and that tend to sort of control prices, I guess you could say, or have influence on the prices. Interesting enough, March of 2020 came along. Here comes COVID. Here's this big drop in the open interest. And then all of a sudden you had this bounce back up to get back into the channel. And then that just kind of wavered and floundered. And as we try to jet back into the channel, it couldn't get back into it and eventually collapsed.
Mhm.
If this was a stock, this wouldn't be a really good looking chart. And so for me, this is it's interesting because a lot of people say, well, okay, you had margin interest rates or margin requirements go up during that time frame, and that may have had influence on the number of contracts. But this is during the same time you had 50 million ounces come onto the registered category. People putting metal onto the exchange and playing the sort of arb game of collecting spreads and premiums and arbitrage. And so it did make a lot of sense why you just saw a complete collapse in activity. But you did have the silver market. You saw the deleveraging where you had the number of ounces, the physical. Paper ounces to physical ounces. Back in 2016, it was 300 to 1, and now it's down to like 7 to 1. I mean, it's really come down because of all the ounces that have come on to the market. And of course, this last since COVID broke out, you had about 95 million ounces before COVID in the registered category, went to about 150 million. Now you just broken back under 100 million ounces that are held in the registered category. So that's demand that's coming out of the market and going into fabrication, minting, that type of thing. Mm-hmm. And this is where I start to tie in what it all means. Is here is a chart with, it's basically the percentage change of the combined open interest as well as for futures, and then in orange, and then you have combined open interest for futures and options in purple. And this is just, again, percentage changes, but you can kind of see this big circle here post-COVID. The price in silver is in blue, and you can see that the open interest in both options and futures has been in sharp decline, even as the price has come out of a big dip in March of 2020, and then just basically oscillating or stabilizing in the 20s, just kind of bouncing back and forth. What I try to do here is I looked at a point in time that was very similar in conditions where you had a massive deleveraging, you had a bounce back in price, and then some type of stabilization price. But at the same time, you had futures and options activity start to decline again. And the reason why I look at that is the futures, if you have open interest in steady decline, that's typically, in most cases, the long activity is being blown out of the market or just losing interest. And the shorts at that point tend to be more of a dominant role. So when the roll comes, when you have to buy back a contract or roll out of your position into the next futures contract, the next lead month contract, you want to see what type of an effect could happen off of that, whether it's if it's the longs that need to roll out of the position and they're more aggressive. When they sell their long position in the front month contract and roll forward to for the next contract, that roll period, they may have more of an impact on the front month contract and push prices down. Whereas if it was the exact opposite and the shorts needed to get out of the contract, like what happened in March of 2020 when you had a shutdown and you had logistics failures and you had mining operations shut down, and banks try to get out of their positions in March, like with gold, and all of a sudden they couldn't because there's no liquidity because all the longs got blown out, 2 weeks prior because of the COVID event. So when they try to get out, they basically they had to buy back at any price. Well, that's when the price and the spreads blew out between New York and London. Well, looking at all that, I go back to 2008, and here you see this big deleveraging event. Contracts implode. You have the price start to spike up, and then you had open interest start to rise again. And then all of a sudden you got this sort of flagging pattern again where silver goes into the 20s and yet open interest starts to decline again. And what I wanted to look at was, okay, if open interest is a lot lighter, and so shorts, maybe the short interest is now trying to take advantage of the roll, or they're hedging their production, whatever it may be. What happens if the price doesn't go down, and it starts to rise? And then here you kind of saw this dominant force of shorts being squeezed and the price starting to take off again. To kind of put this in perspective, this is a little bit more of a snapshot of post-COVID March 2020. It's kind of maybe hard to see, but you have this gray line here where you have the price spike down, and you can kind of see where the physical market, this is showing ETFs and fund flows, which I know what I just said was it doesn't have much effect on price, but the physical market, the direct physical market also came alive during the same time. So it wasn't just metal going into ETFs. It was a lot of buying pressure on the retail side for product as well as 1,000-ounce bars. Well, that big drawdown in price created a lot of long liquidation in the futures market. You saw that with the open interest coming down. And then with the surge in physical demand, you started to see the price start to rise back up here. And then, of course, we know that the premium started to blow out actually on silver as well, where you had that same thing happen in the gold market. Just a short time later, the silver market saw that similar blowout between New York Comex prices and London spot prices.
Mm-hmm. Bob, would you mind just describing the price chart there for us, because it's really hard to see on that chart?
Yeah, it's just this gray line right here of silver. I know it's kind of hard to see. It may not be, maybe a little bit faint here, but it was just basically showing right at this point right here where the price started to collapse. You saw a lot of physical metal starting to be bought, mm-hmm. and as that started happening, that started to anyone who was short the market either had to deliver their contract or deliver against their contract if they own the metal, or they had to roll out and buy that contract back and maybe short the next lead month contract. What happened during that March 2020 timeframe was you had mines shut down, you had everything basically stop. And so you didn't have you had this concern that if you had metal and you didn't want to get rid of it, or you were just hedging on paper and you couldn't actually deliver metal because it just wasn't even available in London, you had to cover that contract back. And that's what put a lot of pressure on the Comex side. And that's where spreads really started to blow out, and Comex prices were a lot higher than London prices. So
at that time, physical demand was really driving the price.
Right, exactly. And that's this deleveraging that I see unfolding here, because since that time frame, I mean, you had a lot of metal come onto the market, and refiners and other users of metal started putting metal onto the market during that time frame and started saying, hey, listen, I'm going to take advantage of this massive spread between London prices and New York prices, and I'm going to put the metal on the Comex, sell the futures contract against the existing metal that I already have, and sort of the refiners got to play the same game that the banks and other hedge funds play, which is on spreads, but the users of metal got to use their own metal as collateral to do this with. And then also you had the issue with London and so forth with collateral financing. So it was easier to move metal onto the exchange and borrow against that metal because it was on receipt. It was secure. It was you had more transparency if you were a lender against that metal. So there was other advantages too. And then this was an interesting thing, and that I brought up another form of deleveraging that we saw. This is the gold contract 2015, late 2015, actually, I think the day the Fed raised rates or the day after, gold had bottomed around 2000 or 1050. But what was interesting was in January of 2016, about a month after that, the gold backing the registered, or sorry, gold in the registered category, which backed the futures contracts, got down to a low of 73, a little bit below 74,000 ounces. That represented, or basically backed all the futures contracts that were open at the time. That was where you had basically a 300 to 1 leverage effect on paper ounces to actual physical ounces backing that. And fast forward to today, that number is now below 3 to 1 because you have about 18 or so million ounces in the registered category. I think it's 17 million something now at this point. But you've had this massive deleveraging of again, physical coming onto the exchange, and you don't have the margin or the borrowing against or leverage of these paper contracts being used as frequently as they used to. Mm-hmm. So what that tends for me to believe is that I don't think you're going to see this massive drop like we saw in 2013, for example, where you have the gold market go from 1,700 down to 1,050 or so. I don't think we're going to see that because you don't have the contracts out there in the open market, amongst all the longs that are susceptible to that sell-off. That the forced selling that kind of comes into that.
Basically, we're much closer to a bottom than we are a top from this open interest standpoint, right?
Yeah, that's what I would tend to believe. And you start to see this when you start using other tools like sentiment measures. You see that with let's see if I can actually pull it up here, but you see it with the bullish percentile, for example, with I don't know if I can pull it up. This is actually the bullish percentile for gold miners, for example, the bullish percentage or percent index. And you can kind of see that, we're at 16.67 right now, which on a scale of 0 to 100, 0 being, everyone wants to give this stuff away and they can't even do that, to 100% saying that, this is the greatest thing since sliced bread. You can see here that the sentiment is just really, really bad. And this tends to be closer to big time lows than it does, some sustained, massive sell-off. It's more of what you call a washout, I guess you could say.
And how far back does that chart go there, Bob? We're seeing that's the lowest low that we've seen on that entire chart.
Yeah, this goes into 2019. Okay. So it's just a few years back, but you can kind of see. I mean, March of 2020 was an enormous crash, and you could see how negative it got in such a short period of time, and it comes bouncing back. But you just want to see how the price reacts, or the time frames are when you get to these big washouts. This right here, this 24.14 right here, that was actually the March low, for example. When you had that initial sell-off in gold down to 1680, I believe.
And we're quite a bit lower on sentiment at this point.
Yes.
$100 higher in gold price.
Right. And the funny thing is, the Fed's balance sheet's growing even more. I mean, yes, they talk about tapering, but they haven't tapered anything yet. And so the balance sheet continues to grow. It's, if anything, this is when the market should be stronger, not weaker. But and then of course central banks are continued buying gold. I think I saw something earlier today about central banks coming in over the summer buying more gold as well. So these are things you just watch for. You're trying to just gauge or use as many tools as possible to help you identify market conditions.
So are we, in a way, seeing this as the ultimate contrarian entry point, maybe?
I think so. To me, this is where it's obviously it's hard to say you're going to have the low, so to speak, because you can always get this massive deleveraging event in the stock market, something that comes out of the blue that knocks it down another 10%, and you get some type of potential deleveraging that goes across the board. The dollar spikes higher, and you have that like a March 2020 scenario. But that's why you look at the open interest numbers and so forth, and margin levels where they're at, the margin requirements. You don't have as many, and especially right now, you don't have the longs in a very big position on the long side to get liquidated. In fact, actually, these guys are closer to being more net short at this point. They're betting on the speculators, the large speculators. It seems like they tend to chase the market. And that's where the commercials tend to take the other side, and they tend to be more on the right side of things. So
hypothetically, Bob, if we got another, liquidation event like that, how long do you think it would take to, really wipe out the physical inventories that are available right now? Like, are we in another situation of, better to be a year early or 6 months early than a day or an hour late?
Yeah. I think within the next, I've always thought by the 2024 election, there's going to be more division in this country that I worry about, because the Democrats are not going to give up control. You're going to have probably more programs, either that or tax rates are going to go up, but something's going to have to support the spending, because the Democrats have sort of lived out this platform of basically socialism, feeding more money into the markets or into the economy as a way to sort of prevent social chaos, I guess you could say, for this the shutdowns and the reaction to that and so forth. But
Bob, we can just mint a couple $900 platinum coins, and somehow that's worth $1 trillion, and everything will be all right, won't it?
Yeah, they don't have to do that. They just create the digits out of thin air. Why even bother with a physical coin anymore? Yeah, it's a quandary that we obviously have to keep interest rates low to maintain debt servicing, not only of the U.S. Government debt, but also municipalities. In fact, actually, I showed, just going back here, it was an interesting chart I just showed. There was an article in early September showing how pensions, 72 pensions municipalities were borrowing money this year to fund their pension deficits. In fact, they borrowed over $10 billion, which is actually oddly more than the 2008 financial crisis timeframe, when stocks and bonds were crashing, stocks were crashing, for example, and some bonds were probably going down as well. But the question I always ask, well, why are they borrowing money when the stock market and the bond market are near all-time highs? It makes little sense, and that just tells you the fragility of this entire structure, especially with pension funds.
Yeah, what really makes you wonder, like, how sustainable is that if they're needing $10 billion to cover their liabilities this year? How can they possibly keep going? Is it mostly due? Are they funding that through taxes, or they like, how are they funding that in a normal year, not a let's say a COVID affected year?
Right. Well, I mean, that's the problem. That's why they're borrowing money, because they're underfunded, and interest rates are maybe about as low as they can go. And of course, on the other side of the coin, with interest rates as low as they are, it makes it even harder to catch a rate of return that they need to to cover future expenses and future pension costs. So the pensions actually get slammed on the other side of the coin because of the artificially low rates. So one of the other things I showed in our presentation I always like to use visual representations as much as possible, but this upper chart or upper picture basically shows, for a lot of people, this market is confusing, it's complex, it's hard to understand, it's overwhelming,
Mhm.
and it's almost by design that way. It seems for a lot of investors, and this is where, whether you're buying futures contracts or you're buying ETFs, structured programs, there's a lot of risks. There's a lot of there's a lot of misunderstandings. There's a lot of assumptions. The ability to get physical metal when you want it. So it just becomes, like you see here, sort of a traffic jam of confusion. And so what we try to do, and this is why I've been doing this since 2008, was we've kind of researched and developed and created these streamlined solutions for investors, wanting to take delivery from all these global programs. We just try to make life easy for people. We kind of take care of the headaches. We've read the agreements. We understand a lot of the processes, and so we can communicate to individuals where they can kind of understand it. And that way, whether it's logistics that needs for transportation, or if it's investors trying to move certain size of quantity of metals from one jurisdiction to another, those are all things that and unless you're in the business, it may seem Greek, so to speak.
Yeah, and it really goes to show, the amount of work that you've put in and the amount of times that you and I have spoken on the show. You're doing the research to figure out what's really driving the price and helping highlight where the actual risks are when trying to own the physical metal, right?
Yeah, there's and actually people can go to the full presentation there, and there is a slide deck, and we go through about, I don't know, 16 or so slides on identifying certain risks, understanding systemic risk and counterparty risk and conflict of interest risk. And you look at foreign storage for US investors and the risks that you got to look at there in terms of reporting requirements. And then you got to look at for foreign investors that want to store maybe outside of their jurisdiction, and the advantages of storing in the US because there's no sales tax or usage tax in Idaho, for example, or no value added tax or goods and services tax. So there's ways that physical investors can participate by just simply buying the physical. And oddly enough, you reduce a lot of extra fees, you reduce a lot of extra risks, and you actually gain control of your own investment at the same time. And that's what we're trying to communicate to investors, whether they're high net worth or retail, as well as institutions. We can show them programs that say, listen, you don't need to buy an ETF if you want exposure to the metal and you want to eliminate so many risks, because the physical market is a pretty liquid market and it trades 24 hours a day. Mm-hmm. And so unlike some of these structured vehicles that, especially with funds, closed-end funds or ETFs, or even not open-end mutual funds, but the ETFs, they can go to premiums and discounts to NAV. And so if the market drops hard, for example, and let's just say you're forced to sell, you could be selling not at NAV like you would be a silver bar at, whatever the spot price is. You'd be selling at a discount potentially to the net asset value of that fund. So that's something you want to be cognizant of.
Mm-hmm. Yeah, really, just understanding the layers of complexity and in a way the middleman that really represent how these ETFs and some of these other vehicles work, right?
Correct. Yeah, and once people kind of understand that, and there's always going to be traders. I'm not saying ETFs are all bad. They serve a great purpose, especially if you're trying to get in and out and you're playing price and you're really just wanting representation of that price, not necessarily actual ownership of the metal. So they serve purposes for certain investors. But I think for the individuals that's saying, hey, listen, I don't know where the economy is going. I don't know what tax policy is going to be here 5 years from now. I want to protect my estate. I want an insurance policy that in case something does happen, that's, creates a lot of friction in the system. I have an asset that's outside the system. And that's where you have to have, a direct relationship with a vault. You don't want to be going through a middleman, for example, where you have a dealer or you have some type of structured program that leases space from a large facility. And now they have a master sub relationship where the middleman is the account holder, and everything that you do has to go through that middleman because you don't really have that relationship with the vault. So understanding those relationships are critical, especially when you get into a situation where, if we see, social instability, or you see political instability, or you see, developing friction or inflation starting to take off, and that's creating problems. You want to be able to have that control. Call up a vault and say, listen, I want to come pick up my metal. You don't want to have to be subservient to a dealer or to somebody else that says, well, we're not in the office right now, but we'll call you back.
Yeah. So Bob, one of the other risks of storing your metal with somebody that is often brought up is the risk of nationalization. So how do you address and think about those concerns?
I have a slide that addressed that. We looked at confiscation. Obviously everyone knows about the Bank Holiday Act 1933. I don't think we're ever going to see physical confiscation in this country. We're just not on a gold standard. We don't trade gold coins with each other. And most of the public does not have gold, any representation of it in terms of physical representation. I think I've heard numbers of, less than 10% of the public are physical metal investors. So the way I see it, it's going to be done through taxation and inflation, which is typically the fiat process of trying to sort of get the most out of the public in terms and satisfying the government's need for funding either debt servicing or funding their spending programs. So really the inflation of prices going up and then taxing it and potentially increasing tax rates down the road. And that's been a big question with the current administration is they're looking at raising taxes because if they cannot raise the funds or if the Fed says, listen, we're going to start tapering and we're not going to support this spending, they're going to have to figure out a way to either come up with the money, themselves, or spend less money up or start spending less money, which is going to have an impact on the economy as well. So that's why I think they're looking at these tax programs, and that's starting to wake up a lot of high net worth individuals that say, listen, I worked hard for my money. I'm not just going to give it all away, whether it be, because it's due to the stock market. Now I am forced to sell those assets because I'm, whether valuation's too high or maybe I think, we could be near a top or maybe I need lesser risk in my portfolio, and then they're going to get hit with higher tax rates.
Mm-hmm. Perfect, Bob. As we wrap up here, is there anything else you'd like to add?
I kind of put together the last slide I did in the presentation. I could kind of read it off. Was something that really a lot of physical investors ask. In terms of when will the physical market dominate price setting activities, or what will it take? I kind of call it for the market to corner the market. Basically, the physical market to corner the paper market. And I sort of put together this the following as a general summary of how I feel this can occur. It's important to note that no single individual or group can absolutely corner or control any market, let alone the silver market. But with that said, history tells us conditions or events can occur that can greatly impact a particular asset market. With precious metals, in my opinion, the motive is not greed, but fear that drives investor participation. A material decline in confidence in the financial or political system can create a natural consequence of sustained demand or trust for trustable assets. This genuine demand can be enough to create a natural corner in the silver market itself. And then, people say, well, how does that happen? And I say, well, in a deleveraging environment, the incentive for players to short paper contracts becomes too expensive, illiquid, or risky. Kind of like what we saw with the March 2020 blowout in spreads. When shorts try to get out of their contracts and started paying up at whatever price they could because they had to close out the position. And so at the same time, the natural demand begins to take possession of physical silver rather than leaving it on the exchange or with a financial entity. This can further reduce leverage or leasing activities. Declining confidence naturally increases the trust for physical assets. Supply diminishes, premiums and lease rates begin rising. Selling or shorting futures requires the risk of delivery versus short-term profits or hedging. Comex may have less of an impact since the market is becoming less leveraged and more physically cash-driven. Margins on futures contracts rise, impacting the cost of trading the contract, and in turn removing the liquidity of the long speculator, which in turn increases the risk of the short seller's ability to effectively unwind their short position. And a great example with this was the palladium market. I think between 2018 2020, the price skyrocketed and you had longs and short open interest decline during that time frame. And then you have premiums or costs on the exchange for physical contracts or other OTC contracts rise, exacerbating the tightness. And then the end result is the underlying commodity has a greater impact on price discovery based on the importance of the physical asset rather than the leverage speculation used to push the price.
Yeah, it's a lot of different mechanisms to consider here, right? And it's only going to matter when it really matters, right?
Yeah, that's the problem you have with silver. Yeah, I think David Morgan kind of coined the term, the price of silver, 90% of the move comes in the last 10% of the time. Mm-hmm. And I think he's absolutely right on that. You see a lot of this with these massive spikes in price, and no one believes it while it's happening type of thing, because we're all used to this, band of volatility and so forth. But that's just how silver moves. It's an emotional asset. It's a small asset class. Money coming into this, if it's coming in correctly, can have a very big impact, on the market itself.
Perfect, Bob. Any last slides before we wrap up here?
That's pretty much it you can see most of the slides. You can definitely go through to the website and kind of follow along there.
Perfect. Of course, we'll have the link to the whole presentation and the slides to your website in the show notes. Your Twitter is @ProfitsPlusID and goldsilvervault.com. Bob, thanks so much for your time today.
Appreciate it. Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.